Medical expenses add up quickly, and any way we can offset them is helpful. Fortunately, the government offers two tax advantage programs, the Health Savings Account or the HSA and the Flexible Spending Account or the FSA. While both are helpful, they have many differences and most people can't carry both accounts. In this video, I break down the Health Savings Account and the Flexible Spending Account so that you understand the differences and can tell which one is right for you. Let's go. Hey, this is Carlos with Influential Finance, and on this channel I make weekly videos to help you improve your personal finances. So if you're new here, consider subscribing. Let's start by talking about the Health Savings Account. An HSA or the Health Savings Account is a tax advantage account for individuals and families with a high deductible insurance plan. Not just any high deductible insurance plan is eligible though. The IRS determines which plans are eligible each year. So always check with your insurance company, employer, or HR department to find out. High deductible insurance plans typically have lower premiums, which is a great advantage for some people. However, the out-of-pocket expenses required before the insurance begins to cover can make a big difference in your budget. A health savings account is money that you contribute pre-tax to use on eligible health expenses. The money also grows tax-free, and you don't have to pay taxes on withdrawals if you use the funds for eligible expenses. You can open a health savings account through your employer if they offer it, or on your own if they don't and you have an eligible plan. You can open a health savings account at a bank, at a credit union, or a broker of your choice. If you want to see a video that dives deeper into HSAs, check out the video linked in the description below. Now that we've gone over what an HSA is, let's talk about the flexible spending account. A flexible spending account is another tax advantage account for individuals and families to help cover medical expenses. You don't need a high deductible insurance plan to qualify, but you can only get the plan through your employer. You can't open one yourself. Like the HSA, the FSA funds come out of your paycheck pre-tax, which lowers your tax liability. For example, if your paycheck is $1,000, but you contribute $200 to your FSA, you only pay taxes on $800, not the full $1,000 that you earned. Flexible spending account funds don't roll over each year. You must use them or lose them. So some employers offer the option to roll your funds over, but the IRS allows a maximum of $550 to be rolled over. You don't pay taxes on withdrawals if they're used for eligible medical expenses. Now that we've talked about both the HSA and the FSA, let's go over some of the similarities of the two. First, contributions are pre-tax, which will lower your tax liability. Second, your withdrawals are tax-free if used on eligible medical expenses. Third, both plans can be offered through your employer. And fourth, money should be used on medical expenses not covered by insurance and other eligible out-of-pocket expenses. There are many differences between the two that we can discuss, so I'll try to stick to the top four. First, the contribution limits are different. With an HSA, you can contribute up to $3,600 for an individual, while an FSA, the contribution limit is $2,750 for 2021. Second, the HSA contributions roll over from year to year, while in most cases, the FSA contributions must be used by the end of the year. Third, with an HSA, your money can be invested and grow exponentially, while with an FSA, your money does not grow or earn interest. And lastly, with an HSA, you need a qualifying high deductible insurance plan in order to be able to open an account, which is not the case with the FSA. One thing to keep in mind is that you can't have both an HSA and an FSA. It's either one or the other. The only exception is if your employer offers a limited purpose FSA, which is not common at all. So, which one is right for you? Choosing between the health savings account and the flexible spending account is a personal decision. Initially, it comes down to what your employer offers if you're employed. If you're self-employed, your only option is the HSA if you find an eligible high deductible health insurance plan through the marketplace. If you have the option for both accounts, consider the following. What do you expect your health expenses to be? If you and your family members are relatively healthy, taking the high deductible health insurance plan and the HSA keeps your premiums lower and allows you to put money aside tax-free for your medical expenses. You can roll the funds over year after year and even use the money in retirement if you never get to use it throughout your working life. all while lowering your tax liability. If you have higher health expenses, you may want to choose a health insurance plan with a higher premium but a lower deductible. If you don't take a high deductible health insurance plan, then you aren't eligible for a health savings account, but you can get some tax benefits by electing an FSA if your employer offers it. That pretty much wraps it up for this video, but if you'd like to watch a video that dives deeper into HSAs overall, check out the video right up here, and as always, make sure you click on my face right here to subscribe for more weekly videos. That's been it. I'll see you in the next one. Peace.